Okay, great. So, good morning, everyone. This is Priyanka Mathur from CII-ITC Center of Excellence for Sustainable Development. Thank you all for joining us this morning. We will get started as other people log in and connect for this webinar. Now, from this level of participation, it does seem that we, mostly have companies which fall under the purview of SEBI Circular, which has kind of gained momentum since last year. Now, the participants are primarily from, these top 500 listed companies, which also includes, entities from financial sectors like banking, insurance, and other financial services. This webinar is primarily focused on how these entities, would choose the relevant capitals, reporting on these capitals, what are the key indicators, reported by banks, financial institutions, etc. So for this session, we decided to have one speaker from an Indian bank and one from an international bank, giving their perspective on integrated reporting. So we are very encouraged, and once again, thank you all for joining. Now, before we get started, a quick look at the flow of this webinar. We will start with a quick recap on IR in India and understand the SEBI circular requirements. This will be followed by discussing the IR framework from DBS Bank Singapore, giving their global perspective. And the third part of the webinar will be touched upon by an Indian banker who will share his integrated reporting journey and his understanding of the IR framework. And in the end, we will have a Q&A round for addressing your queries, for all the participants' queries. May I request all the participants to please keep your questions short, and we will try to address as many as we can depending on the availability of time. I'm very glad to introduce our speakers for the webinar today, Michael Larson and Abhijit Agarwal. Michael is Managing Director, Chief Sustainability Officer at DBS Singapore. In recent years, DBS has been strengthening its sustainability agenda in various ways. In July 2017, the bank was the first financial institution in Singapore to issue green bonds to support the financing of green assets. It was the sole book runner of Singapore's first corporate green bond in April 2017. As an affirmation of its commitment to sustainability, DBS was also the first Singapore bank to be included as an index constituent of the FTSE for Good Global Index in 2017, making it one of 8 Singapore listed companies to be globally recognized for its environmental, social, and governance practices. And prior to joining DBS, Michael was CFO for Asia Pacific in UBS, from covering investment bank, wealth management, and asset management. He was also the Asia Pacific head of accounting policy and location controller for Hong Kong at UBS. Michael has also worked in Citigroup and KPMG in London and Denmark. Our second speaker for the day is Abhijit Agarwal. He is Deputy Vice President, Corporate Affairs at Axis Bank. He leads Axis Bank's corporate sustainability vertical and comes with over a decade of experience in sustainability, corporate finance, and strategy. Prior to his current role, he was with Yes Bank, where he was a senior member of the responsible banking team and led the release of the Indian banking sector's first integrated report. Before Yes Bank, Abhijit was with the SR Group, handling finance and sustainability roles in their shipping, telecom, and energy businesses. Abhijit has a PGDBM from IIM Calcutta and a bachelor's degree from Drexel University, USA. Abhijit has also been a speaker, trainer, and writer on key sustainability topics. I'm very glad that you both are here for the webinar. We'll be able to gain so much of knowledge when you both discuss your experience of integrated reporting journey. I have been part of the center since 2.5 years now, being primarily involved and leading integrated reporting initiative at the center called IR Lab India, and also look at Sustainable Plus label, which is India's only corporate sustainability label. I have the prime responsibility of reaching out to corporates for the IR framework, thereby trying to increase the pace of adoption in India. Also hand-holding first-time preparers with the focus on high-quality reporting of the framework. I have close to 9 years of work ex, which is spread out across sustainability, finance, and business research. Now, very quickly, I would like to talk a little bit about our center. CII-ITC Center of Excellence for Sustainable Development is a not-for-profit industry-led institution. Our main mandate is to help companies become sustainable organizations from economic, environment, social, and governance point of view, and make them entities that create sustainable value for their relevant stakeholders. And because we are part of CII, we are able to leverage our position to create an all-inclusive ecosystem of bringing the stakeholders together, maybe the industry, the government, but also parts of the civil society and academia. And historically, we have been pioneers of integrated management systems, biodiversity mapping, integrated reporting, sustainability reporting, and social and national capital valuation in India. Our center's knowledge, action, and recognition activities enable companies to be future ready, improve footprint profiles, and advocate policymakers and legislators to improve standards of sustainable business through domestic, global, and global policy interventions. Our center is located at 3 different parts in the country. We are based in Delhi, Gurugram, and Mumbai. CSD also operates across the country and has been active in parts of South and Southeast Asia, Middle East, and Africa. We have held institutional partnerships and memberships of the United Nations Global Compact, GRI, IRC, and CDP, development agencies of Canada, the US, the UK, and Germany as well. And we are very glad that we were the ones to work with IRC to bring integrated reporting in India. In a way, we are actually very delighted that things have started to move forward. And we are able to strengthen our working relationships with IRC by collaborating more on various themes and formats. All in all, our attempt is to make Indian corporates globally competitive, but also in a sustainable manner. Now, the initiative, IR Lab India, is a collective of different stakeholders of the business ecosystem. Of course, the companies that have to do integrated reporting, but also the market regulator, both the stock exchanges, BSE and NSE, 3 professional institutes, academia and audit firms, all of them form a part of this initiative called IR Lab. Some of the key achievements that we have had since our inception is the SEBI circular on integrated reporting, as you all know, which is voluntary at present. Now, the regulator is still going to take some time to not make it mandatory and prescriptive. The lab and we, as CII, we don't want it to go down the path of the national voluntary guidelines and the business responsibility reporting. It is really the practice, that the companies have to realize the value of integrated thinking and integrated reporting, rather than really look at it from a compliance point of view. We at the lab, we feel it is an amazing management tool. So we always tell the companies, please, grab this opportunity to look at this framework. So from our lab, currently 4 members have practiced IR: Tata Steel, Wipro, Reliance Industries, and Yes Bank. Another member, Tata Chemicals, they have already touched upon the 6 capitals and described the interlinkages in the annual reports. And one of our recent members, Apollo Tyres, they have started their IR journey, and we are glad to handhold them through this transition. Our view on the integrated reporting in India is that now there are many companies, outside this lab as well, that are currently looking at integrated reporting, either through an internal release within the organization or an external release on their public domain. Our estimation is that there will be many companies which will come out with an integrated report for FY18. And by FY19, we will see a major movement, as by then many of the companies would have come up the learning curve to either adopt or evolve their integrated reports and have a better understanding of the framework. How is CESC helping companies to do integrated reports? So our main work is on capacity building, and that is through webinars like these. All our webinars are recorded and available on our website for your benefit. We also conduct training workshops across India, both external workshops and in-company training sessions as well. Our recent workshop was conducted in Mumbai in February this year at National Stock Exchange, and the forthcoming workshop is scheduled in Delhi in October. Please get in touch with us for more details for this webinar. The other value addition work that we do for companies is the gap analysis. It is basically done from a content point of view. We have helped many companies with the gap analysis to begin with. Most of the companies, as we feel, have a lot of information that would go in an integrated report. As a result of their annual reporting, their corporate governance reporting, sustainability reporting, BRR. So all of these that you would be doing, most of the companies are doing anyways, and these are the basic requirements from the reporting point of view. So this gap analysis is primarily conducted to identify informational gaps, such as information that the companies might already have, and what is that information that we still do not have. And there could be two parts. One, that you could use the information that you have as it is, because it is ready for you to put in your integrated report. It's in good shape. And the other is something that you have it, but you just need to reorganize it, repackage it, keeping in mind the requirements of the framework. And then wherever the gaps are, you have to get the information and put it in the way that would be useful to your stakeholders. We also help companies in understanding their sectors, in understanding their peers, who they would sort of want to refer to for their reports, who they would want to do a peer group analysis. So we help companies in doing this analysis, peer analysis for them. And also considering our center's core competence, we have a competence in business model design and articulation. So we are offering that to the companies to articulate their business model concisely in their integrated reports. And because of our work in sustainability, we do have the methodologies and expertise to value social capital and natural capital. So we are available to help you with these two capitals out of the 6 capitals. Now I would quickly talk about IR is sort of an evolution of corporate reporting. It is very important for us to understand that integrated reporting is not an improvement of financial reporting. It is neither an improvement of your sustainability reporting. It is also not a combined report, and it is neither taking your annual report and your sustainability report and binding the two together into one report and saying, here it is, this is my integrated report. It is not juxtaposing different reports together as one publication and putting it out. It is, as we talk to so many companies and we constantly keep telling them, it is not about saving pages, or it is not about adding more pages to your report. It is really about connecting the different issues, connecting the dots together, putting it together, and therefore the term integrated. How do all those issues connect together in an integrated manner? So we constantly again keep telling it is integrated reporting framework is as much a management tool as it is a reporting framework. We tell them to first internalize this and then use it to communicate with various stakeholders. We want the companies to approach integrated reporting as a management tool. Now, why we say this? Because we feel that the companies will be able to derive more value, more benefit by improving their understanding of their activities among relevant stakeholders. And hence, I feel that it is sufficient to say right now that integrated reporting is an evolution of corporate reporting, taking it to the next level. Now, the current status of the reporting framework in India is the SEBI circular. A quick glance at this circular and its requirements for all those who still haven't had a chance to look at it can find it on SEBI's website. You can also view our last webinar, which is available on our YouTube channel, CII-ITC CESD, where we have discussed in detail about the circular and what it is trying to communicate. So we will quickly try to understand certain parts of the language of the integrated reporting circular. The circular, as most of you would know, is quite simple. It applies to top 500 listed companies which are required to prepare the BRR mandatorily. As their market cap as per 31st March of the financial year, the companies have to prepare BRR, are also now recommended to voluntarily prepare integrated report. Now, when does this get into force? The current financial year, which gets over in the next 4 days. This year would be a first annual report to convert into integrated report by adopting the framework with one of the 3 options available as per the SEBI circular. How do you publish the annual report? This is something which is very interesting. There is no need to prepare a separate integrated report in terms of printing it, a hard copy. Make one, put it on the company's website. However, if you already have an integrated report, reference it to the annual report, and that would suffice. Which part of the section of the company's website? Ideally, it falls under the investors section, because that is where all your periodic reporting goes. So whether it is your corporate governance report, your financial statements, your annual reports, gradually now even the sustainability reports actually also go in the investors section. So that's where ideally your integrated report would also feature. A little bit more. Now there are 3 options that the circular talks about. And the reason why there are these 3 options given is because the practice of preparing integrated report is still relatively new. It has only been 4.5 years since the framework was launched, and therefore there are different types of practices. And even in India, we have seen, for instance, Wipro, for its annual report published, for the last 2 consecutive financial years, the company has structured its MD&A section according to integrated reporting principles and capitals to highlight the importance of non-financial disclosures. Tata Steel has converted its entire annual report for the last few financial years into integrated reports. So these are the 2 options. Then we even have the 3rd option, which is in use around the world, where you could have a separate chapter. So for instance, if you have an annual report, you could actually begin the annual report with a comprehensive and brief integrated report, and then the annual report could follow. Now, these 3 options have been given because the practice, as I said at the beginning, is relatively new. And we will see how companies progress from here and what is the most preferred option. And then perhaps in the future, there might be just one way of putting the integrated report. Now, when you have an integrated report, there will be a lot of content overlapping. There are the companies have their directors report, different parts of the annual reports, financial statements. In India, specifically the BRR as well. You will most likely have a separate sustainability report as well. So all of that, you don't have to necessarily repeat or duplicate the information in the sections in a separate IR. All that is required is that you just need to cross-reference the information. So keep your integrated report brief and concise in a way that it is actually supposed to be. The details could be in the relevant disclosures, which is stipulated either by the regulator or you are already using your voluntary reporting framework, such as the GRI, for your sustainability reports. And if you are also reporting in the US, then maybe you also come under the mandate of SASB, and so you can even cross-reference with those reports. So look at the entire web of different reports, different disclosures that you have, and then use the cross-referencing rather than duplicating it and replicating the information, and then again, as I said, adding more pages to your report. Now, integrated reporting, this webinar today, as we have decided on this topic, integrated reporting concept of capitals for financial services. Now, the reason why we decided to discuss the capitals of the framework, primarily for the banks, for financial institutions, is because many times when we discuss this framework, a lot of questions came around to us, like, why as a bank do I need to address a particular capital when it is not even relevant for me or it is not material to my business? How do I draw interlinkages to the relevant capitals? What is the interconnectedness of my capitals? So to answer all these questions, we decided to bring in the experts who have already faced these challenges while they were on the integrated reporting journey. These banks have already deep dived on the concept from their industry's perspective. So we wanted them to share their views and experiences as financial institutions to address some of these questions. I'm hoping that many of you will be able to gain knowledge from this session. And so a quick mention before I stop here and hand it over to Michael is that IIRC has an IR banking network, an IR insurance network. I think they even have the investors network. So under the banking network, they have released few publications. Please go through their website and access these reports. They're very informative. You'll be able to understand the concept, from IRC's perspective, what the framework is talking about, and they have touched upon various aspects of, the framework. Now, I'd like to stop here and hand it over to a speaker. I welcome Michael Larson, who's joined us from Singapore. Over to you, Michael.
Now, thank you very much. Are you able to see my slides now?
Yes, Michael, we can see your slides.
Excellent. Well, thank you for giving me the opportunity to spend these 15 minutes telling you a little bit about the experience that we have at DBS. For those of you who don't know us, we are one of the largest banks in Southeast Asia with presence in numbers of countries out here, obviously including India. We've been at this journey of integrated reporting for about 5 years now, and for the last 3 years, we've also been doing GRI sustainability reporting. So we were one of the very first one that did this, and it came as a realization that what we had before that, which was nothing much more than a simple annual report, just didn't really match up to our aspiration of telling our story of our strategy. So we needed something else. And so integrated reporting seemed like an appropriate tool to kind of find a way to explain our business model and how it creates value, not just for the short term, but also those that are embedded into other capitals and eventually will turn into profit or financial capital. We decided very early on that we did not want to have a separate integrated report. Neither did we want to have a separate sustainability report. So if you look at our report today, our annual report is our integrated report, and it contains within it our sustainability report. And that's important for us because we do not see sustainability as a separate thing from our other capitals, and therefore it needs to be part of how we explain the value proposition, our business model, and our strategy. So take a look at it at some point in time if you want to understand how at least we think about integrated reporting. We've been looking at the concept of capitals for quite a while, I would say. And as you will see in one of my next slides, we came up with our approach to how we want to think about it. That's by far not the only way, nor is it possibly the most advanced way, but we think it makes sense in the context of a bank and in our context. We also heard it a little while ago that the banking industry group has done some research on this topic. I happen to be the chairman of the banking industry group of IIRC and was the author of the paper that specifically talks about how banks this is about a year or two old now, has adopted the capital framework into their reporting. So I also encourage you to go and have a look at it. Okay, so when we think about capitals, let me see if I can. There's a few things we know, and there's a lot of things that we don't know. Because you see, when you start to look at capitals, you realize very quickly how complicated it is to, in a concise way, articulate the value of your capital. One thing we know for sure is that there's not always a one-to-one linear relationship between the capitals, input and output. For example, as you can rightly imagine, if you put in investment into your staff or pick up an intellectual property, that does not lead to a one-to-one increase in manufactured capital or financial capital or any other types of capital. Obviously, all the capitals work together in a symbiosis to create the other type of capital that you had at the end of the year. And so one should, in my mind, avoid the simplistic thinking of thinking that you can create a simple correlation between the capitals that you have as input and those that you create as output. The other thing that is interesting to understand is that the capital that you use as inputs are very often the same ones as you have as the outputs. Very simple example is if you upskill your staff, well, then clearly your staff is that capital at the beginning of the year. And if you upskill them, that's also the value that you create. You've increased your capital at the end of the year by a more intelligent or better prepared workforce. I also think that rather than trying, let me take a step back. One could take the view that you would want to measure capital in the same way as you do any type of other assets under the IFRS framework. And so, in a way, you could think of IFRS as being insufficient and IRC or integrated reporting as a way to measure quantifiably each of those capitals that are not allowed to be measured under IFRS, IAS 38 or whatever other standard. I think that has maybe a long-term value, but I think it is too premature. Therefore, I advocate the use of KPIs, and you'll see the ones that we're using shortly, as the best way of trying to point investors to the value of the capital that they don't see in your balance sheet. And then you might also ask, well, what happens with the value that I create that doesn't stay with the organization? For that, we believe that the value distribution framework that is also part of the integrated reporting is a good way to think about it. In other words, the money you pay out to employees in terms of bonuses, or that you pay to your investors as dividends, or that you pay to society in taxes or other forms, is one way to articulate the value that you give back to society. Now, what do we not know? We do not know, at least we don't, exactly how the synergies and trade-off between the capitals work. A lot of work would need to go into trying to figure out exactly what is that complex web of correlation between the different capitals. We also do not know the trade-off between the different stakeholders' interests. In other words, when you do report value to your shareholders, it is inconceivable in my mind that we could always figure out exactly what the different stakeholders want of us. What is the appropriate amount of bonus to pay? What is the appropriate amount of money to retain for reinvestment? Those trade-offs are very real, and the best way to articulate that is to figure out who you primarily use your integrated report to report to. And then also a complex point that you would have to figure out is what is the trade-off when you look at your KPIs between making it specific to your organization vis-a-vis making it comparable to other organizations. Because if you want to tell your integrated reporting story, you would want something which is highly tailored, but that most likely means that those same KPIs are not represented by other banks. And then how do you then compare? Okay, so the next slide is a prelude to what you will see in our annual report that comes out tomorrow. So you got a bit of an early bird here, look at it. It doesn't look very different from our 2016 report, but we have made slight changes. So what you're looking at right now is the capitals that we have termed as relevant for how we build our franchise. So starting on the left side, it's brand value, it is customer relationship, digital capital, employees, financial capital, which includes both funding and our shareholders' funds, physical infrastructure, natural resources, and societal relationships. The first thing that might spring to mind here is those doesn't follow the standard set up by the CII-ITC, and that's correct. Because you see, CII-ITC doesn't mandate that you use exactly the terminology that they use. You use the terminology that makes most sense for us. And DBS, one of the key distinguishing features for us is we want to be digital to the core. And so therefore, the third row that you see on the left-hand side here is how we believe that we create value in being a digital bank. And that has to do with the KPIs, which you see in the second and third columns. I know it's very difficult to read, is our way of representing what we feel the value is generated. So if we stick with this third column, digital value, you can see that digital customers, we had 2.2 million digital customers in 2016. Now I blanked out the numbers for 2017, but in the annual report tomorrow, you'll then see what the number is for 2017. And this is our simplified way of thinking of a balance sheet setup for the capitals. But we also recognize that even with this setup, which we think is the most appropriate one, even that is insufficient to truly capture the complexity. Because if you look over on the right-hand side and you look at our physical infrastructure, that also has elements in spending on IT. And if you look one down from in the same column, you also see that we also have our branches network mentioned. Now, why would we go and co-mingle IT spend with branches? It is because we only can think of a reduction in branches as something sensible to do is if at the same time we improve our IT online services. So in a way, to tell the story, you need to, in one snapshot, show perhaps an increase or reduction in branches together with your improved service offering online. And so all of these things have to be considered when you decide on what capitals you want to report. Okay. I mentioned also the idea of the value distribution. And this one, I don't think we are very different from anybody else reporting it. But this is one way, and again, I blanked out a couple of numbers. This is one way to show that we give we give back both to society, to employees, to our shareholders, and we reinvest a lot into our franchise. The key thing to note with one of these diagrams, value distribution, is that no matter how well you try and do this, it will always be incomplete. Point being that what you give back to society and to employees is measured in many, many ways, from training to being an active participant in society's debates. And that is very hard to quantify and much harder to capture on a consistent basis. So you need to make a trade-off in terms of how far do you want to push this ability to measure the value contribution, because obviously accuracy comes at a price, which is not just a tangible physical price or a monetary price, but also you end up being possibly overly precise. Now, that's all I want to say in the interest of time on DBS's journey towards this. I'm happy to take questions, but before I leave you, I just wanted to mention this report that I talked to you about before. So I mentioned that there is a paper that you can find on IRC's website, and that effectively looks at how the different banks report capitals. And in the next slides here, you'll see that one of the things that was reported by the largest portion, all 11 banks that we looked at, was financial capitals. What you can see on the fourth column is the different KPIs that they chose to represent their financial capital. And it ranges from cost-income ratio to return on equity and all the way down to net profit. You can see on the right-hand side that there was a diversity in the numbers that they chose to report, and it was quite wide. The next one down was manufactured capital, where most people chose to show their number of branches and ATMs. But again, the diversity was quite great. Following on from that, intellectual capital, there was a preference for something that was easily measured, which was brand value and rankings. But there were also a number of other things, including training hours for employees, were by some companies perceived as an intellectual capital. Human capital had a number of different KPIs, as is society and relationship capital and natural capital. I wanted to finish on one note, which is for those of you who are ambitious and want to report both integrated reporting, GRI, and integrated reporting, you're going to have to find a solution for two conundrums. One is the fact that, to my mind, integrated reporting is more focused on how society and the changes in the environment impacts your company, whereas a sustainability report arguably is more interested in looking at how you impact the environment and society. So there are two different lenses, and you have to figure out how you're going to square that off. The other one is the use of natural capital, which is not constrained in your context in the same way as the other ones are. For example, you only have so many employees, which has a certain level of education and knowledge. That is a constrained resource. Natural capital is globally constrained, but it may not be constrained to you. Maybe you don't have a water shortage that you have to consider as you run your company. And so the way you report natural capital will arguably have to look different from the other capitals, because you're not growing or reducing the global pool of capital, but you are using them in your production. I hope that was clear. So with that, I will hand it over to the next speaker, and I'll be ready to take questions as they come along. Hello?
Hello. Thank you, Michael. If anybody has questions for Michael, please put it up on the window which says questions, and we'll take it up after the next speakers finish. So I'm going to hand it over to Abhijit now.
Hi, can everyone see my screen? Good day, everyone.
Yes, Abhijit. Yes, we can see your screen, Abhijit.
Thank you so much, Michael, and really kudos to you and DBS Bank also for really mainstreaming IR in the APAC region and even beyond. And I think we are all learning from you. So on that positive note, I'd like to start. So good day, everyone, and welcome to my session. So while both Priyanka and Michael talked about the concept of integrated reporting, and I think Priyanka very nicely you touched upon what the SEBI circular says, I would just like to kind of build on that and also share some thoughts of my own on what, from an Indian FI's point of view, which could be a bank, which could be an NBFC, which could be an insurance company, which could be a small payments bank, and I mean, many of you would be aware of the variety of financial institutions we have in this country. So it could matter to everyone. So like Michael said and Priyanka said repeatedly, that every organization has to find and identify what is value for them, what do the capitals mean to them in particular. So to begin with, what does integrated reporting mean for finance? Well, it's the same as every other organization. So like I think it has been said before, integrated report and IR is not a different set of parameters to report on. It is not a separate report. What IR aims to do, and most importantly, an IR integrated reporting is not prescriptive, right? There are no parameters, or so those parameters the IR expects the organization, the reporting organization, to set for themselves. So what at the top level, what is an IR? It is basically your vision, values, and strategy. It is your corporate governance. These are basically the things. These are the things which every external stakeholder would want to know from an organization. So while you do share your financial information, but do you also share your risks or opportunities? What is your value chain? What is your performance? What is your outlook for the future, right? So these are the things which IR focuses on. main purpose of IR, I think Priyanka, you had also mentioned, is to break down the silos of reporting. So it is not just about presenting a financial statement, your profit and loss, and then talking about your impact on the environment and the society somewhere else. The purpose is to bring it together because they all have an impact somewhere. If you see my second last line, the intangibles are a large part of organizational value today. I believe about 70 to 80% of an organizational value today consists of intangibles, whether it's your brand value, whether it's your goodwill, and all these things matter, and they impact a lot of things, and they're impacted by a lot of things. So one of the, I think the bottom line of IR is to put yourself in your stakeholders' shoes. So like I think Michael, you had mentioned that, what do your stakeholders want to know from you as an organization? What do they expect from you? And that is somewhere I think IR looks to focus on. And this is true for financial institutions as well. So the what does an IR begin with? It's integrated thinking. All of you would be aware of that. So what the primary purpose, when many of us perhaps would be first-time reporters using the IR framework. So the idea is to sit together, is to bring together everyone. So purpose is to create an integrated thinking across the organization. So like I said previously, that the idea is to not report in silos, and that's what an IR aims to do. Right? So what role does an FI play? I think every financial institution needs to sit down, and what is the role in the bigger scheme of things? So we believe that an FI is a catalyst for economic activity. That you have to realize that as an organization, you're not, because you're a financial institution, you are in the process of giving money. You're process of taking money. You are in the business of trust. So that is something that is very important, that it should reflect in what you report and how you report. So your business activities do not just create financial value. I'll come to examples of that. So for example, the FIs in India, which parts of the economy are they busy in? So for example, banks today are funding core infrastructure. Small payments banks are using digital technology, are taking banking to the grassroots of the country. Banks, financial institutions today are funding mass transit, affordable housing, education, healthcare. The MSME sector is a critical element. The SHGs, self-help groups, and microfinance. Now these are all the core business areas for a lot of FIs, and also it is to be realized and it has to be recognized that they all have a very strong positive, mostly I would like to believe, socioeconomic and environmental impact and relationship. So I have listed few examples. For example, financial inclusion. What is the role of microfinance? While microfinance is a business model for a lot of FIs, one has to realize that when you lend money to the bottom of the pyramid, when you are creating economic opportunities for them, you are helping them improve their lives, and that is a huge social impact. Similarly, financial literacy. So RBI has mandate for banks to mainstream financial literacy. A lot of NBFCs take it upon themselves. A lot of insurance companies are working very hard to mainstream education on insurance. All this has a very positive socioeconomic impact. It is basically making people more aware. It is helping the people at the grassroots come up in the financial sector and kind of integrate with the mainstream financial sector here. So that being said, that again, while IR is not prescriptive, I say at the same time KPIs and targets do matter for stakeholders. And it's not just external stakeholders, even for organizations. It is extremely important for organizations to come together, for an organization, the internal stakeholders within an organization to come together and discuss what are the KPIs. Now, for example, a very good example is, how do you measure trust? If I'm an FI, how do I convey that there is trust? My stakeholders have trust in me. And it could mean a lot of things. I can give you a few examples. For example, customer satisfaction. Every FI will have exercises, will have external agencies working on measuring trust, customer satisfaction. That could also mean, for example, how many of your customers are coming back for repeat transactions. That's a very simple thing. How many complaints are coming in? In India, companies are mandated under Companies Act to report on the number of complaints received. So those could be the sort of the KPIs that you can look at, and then companies can take take targets based on those. That customer satisfaction, it needs to be above 95%, for example. Target. Same with environmental footprint. So a lot of companies now, thanks to mainstreaming of GRI reporting, thanks to BRR, now a lot of companies are looking at measuring and mapping their own environmental footprint and even the kind of impact they're creating outside. So like if you see the last line, an FI's larger impact is outside the organization, because you are lending to the sectors of the economy which have a massive social and environmental impact. And that is where I think FIs must recognize their role. Going forwards, the pertinent material issues, again, which have typically, in my experience and in various studies that have come up, what are the material issues which stakeholders have cited for the financial institutions? Customer privacy and data security. I think those who have been keeping tabs, those outside on what the current state of the Indian banking sector is. Trust is a huge question mark these days. Trust has come into question from a number of places and from on a number of issues. So regulatory compliance, again, has been in the news for a lot of reasons. Financial inclusion, I mean, the way financial inclusion has grown in the last few years, whether it's your Jan Dhan, whether it's your Mudra loans, that's been a huge issue and a huge focus area. Sustainable finance, like I said, FIs invest in those sectors which have a positive impact going forward, whether it's renewable energy, whether it's your clean coal, whether it's your mass transport. Similarly, risk management again has been it's a very critical issue, I think, for financial institutions, because like I said, we are in the business of trust. We are custodians of people's money, and that's why risk management becomes very important. And like Michael has mentioned, the environment and social risk of our portfolio is becoming increasingly mainstream now. And I think slowly, even the governments are talking about, the regulators talking about, how can we integrate environment and social risk management into how we lend, into our credit appraisals. KYC, AML is very critical, especially for FIs who are in the retail segment, who have customers, who have retail customers, especially at the bottom of the pyramid. The know your customer, anti-money laundering rules and regulations increasingly come into question also because of some of the negative news around it. Similarly, with corporate governance and ethics, it becomes increasingly important simply because the FI's position as a being in the business of trust. I had mentioned to you customer satisfaction and community impact. Like to add a line on community impact, who are your next, for a lot of FIs, who are your next set of customers? They'll be the millennials, they'll be educated. India, for example, is becoming increasingly urbanized. So your next set of customers will probably be the young professionals living and working in the cities. And for them, these issues matter a lot. What are you doing for the community? What are you doing for the environment? Are you playing your role as a part of our community, as a part of the society? So coming to the capitals, I think a lot has been, Priyanka and Michael have talked about a lot about what are the capitals, and like it was mentioned, it is up to the organization to bring its internal stakeholders together and kind of discuss that, what are the things, what are the factors that value, that matter to you, and what are the factors that create value internally and externally. So financial capital is perhaps, in my opinion, the most important capital around which your reporting and your disclosures can revolve around. So for example, like I had mentioned, you need to identify what are the business activities. Firstly, you need to identify what are your business activities. And to be extremely honest with all of you, a lot of organizations today are used to working in such silos that they do not know where their impacts lie. They do not know what their set of activities are. For example, a lot of companies may not even be recognizing that we do some sort of employee training. So the kind of investments they're making in their employees, it does not even reflect to them that could have an impact somewhere. Right? So that is where financial capital comes in, that one needs to map, all the FIs need to map what are their business activities. Then the next step would be that what are the business activities that have a positive socioeconomic environmental impact. There's something I think Michael had touched upon in his slide as well. So again, to give you those examples, is banking at the bottom of the pyramid, which has a huge socio-economic impact. The renewable energy lending, agriculture. Now, agriculture is again a very critical issue in India, especially, and it's going to get so because as it has huge risks and opportunities associated with it. Rural banking, I will touch upon these also in the other capitals as well. Small retail, like I'd mentioned, MSME lending, because the MSMEs are a very critical sector of the economy, and what are we doing, what is an FI doing to them? Digital banking, again, digital is perhaps a very critical emerging issue across the world, across the economy, and especially for FIs. In India, the way digital banking has really been mainstreaming, whether it's internet banking, especially mobile banking, banking on tablets, those have really picked up. UPI, those have really picked up, and that needs to be reflected. Or FIs need to recognize that and measure that. What is their role there? So coming to social and relationship capital, again, mapping its business and non-business activities. So typically what even the IR recognizes social and relationship capital is what are you doing for the community? And for a lot of organizations, including FIs, that translates to what are you doing in terms of CSR, your corporate social responsibility. But at the same time, like I said, the offshoots of your business activities also can have a huge social and relationship capital, positive social relationship capital. For example, the amount of money, the amount of resources you invest into creating financial literacy, right? That has a very positive impact, not just on your brand, but it perhaps and a lot of FIs recognize that it also creates your customers for tomorrow. Similarly, next is intellectual capital. So again, intellectual capital, from an FI's perspective, is perhaps similar to what other organizations do when it comes to intellectual capital. But so if you, as an organization, you need to sit down and think, where are you heard in an external environment? What are the issues that you talk about externally? Right? For example, it could be your MD and CEO, your top management speaking at conferences on certain issues. It could be financial inclusion, could be anything. A lot of FIs, almost all of us would be parts of business associations, industry groups, where we are talking on certain issues, where we are trying to create an impact, or trying to steer business or the economy in a certain direction. Those are the kind of things that need to be reflected and captured. The next thing, again, which is something I think a lot of FIs and a lot of organizations themselves, haven't come across focusing on, is trying to capture intellectual capital in terms of the tangibles. What are the certifications, patents, experts, are the benchmarks you've set? Are you recognized as benchmarks somewhere? So coming to natural capital, again, mapping your business activities with positive natural capital impact. That's, again, I've mentioned that, renewable energy lending, even reducing the footprint of your own business. Digitization. Now, a lot of organizations are heavily, in India especially, are adopting digitization, process improvement through digitization. And that is a huge, apart from adding operational efficiency, it has a huge natural capital impact as well. So do try to recognize that. Similarly, offshoots of your regular business activities. I have listed a simple example of business correspondence banking, under the RBI regulations, where through business correspondence, you can take banking to the doorstep of your rural customers. So what does that do? It reduces their need to travel to a branch. And in rural India, branches are brick and mortar branches are few and far between. So that kind of a integration and a thought link has to be created. So, like I said, CSR initiatives, positive environmental impact or CSR initiatives. And from a KPI's perspective, typically they are your emissions, what are your consumptions, what are the initiatives you've taken, so on and so forth. The next one is human capital. Again, this would be similar to a lot of all the other organizations, is what is your organizational philosophy towards your employees? Like, what is you as an organization are doing to improve your employees' competencies and capabilities, learning and development. Right? So from an FIS point of view, what a reporting organization could look at is what are the material issues. I listed some of the material issues earlier: customer privacy, customer satisfaction, data security, money laundering. So perhaps when you report, you need to look at what am I doing in all these things? How am I strengthening all these factors? And that is where your human capital could perhaps focus on. Like I said, what are you doing to keep your employees motivated, loyal, ethical, these things. So coming to manufactured capital, again, this is a very, in my experience, this has been a very common theme among service sectors, is what does manufactured capital mean to me? So even if an FI, you as an FI ask so, but do remember that you also occupy offices. You do remember that you also have a physical presence somewhere. So then from an FI's perspective, what is manufactured capital is what is the physical space you're occupying? Like I think Michael had also mentioned, your branches, your offices. So how do you try to measure and report on the value that your manufactured capital is? So like I mentioned in the last line, how has your physical infrastructure expanded? And you may like to break it down further. How many branches do you have in rural areas? What is your presence? How many feet of ground do you have in, say, bottom of the pyramid? How many BOP touch points? These are the kind of things which have a positive socio-economic impact as well. So this is the kind of KPIs that an organization can look at reporting. This is my last slide. Yes. So again, has been repeatedly mentioned by Priyanka and by Michael as well. It's how to harmonize integrated reporting. See, I would like to believe, and I think you'll will agree that see, IR is not an additional platform of disclosures, because typically that has been the first reaction, even to the SEBI circular, that is this another report for us to make? But I would not like to believe so. What IR does is, if you see, read my second line, is that it makes what you're reporting on, make it more stakeholder focused and make more future oriented. You are basically now reporting on what your stakeholders want to hear. And organizations may use this framework to to particularly improve their existing disclosures. Like SEBI disclosure, the SEBI gives a lot of options. The IR itself gives a lot of options. It's extremely open-ended in terms of how you may use it and where you may use it. So in India specifically, if you look at the list I have put down, so there are many key IR elements that are already captured in our disclosures, which Indian companies are required to do. Your annual report can have your MD&A, management disclosure and finance, which has your corporate governance. Your corporate governance report has your corporate governance setup. Your MD&A talks about your business segments, what is their performance. Your key organizational initiatives are you mentioned in your director's report, in your MD&A. Risk and opportunities, strengths and weaknesses. Increasingly, most annual reports are covering these. Economic and business outlook is a very important part of your MD&A. So that, and now India has the CSR rules. So most of the companies now have a separate report on, which is part of the annual report, your CSR report, which lists down what are the activities, CSR activities you've done, what has been your community impact. That is it. And then the BRR. The BRR has been there for about 5 to 6 years now. So the BRR has a lot of information which can be relevant to an IR. So as it was mentioned, as Michael mentioned, the key is to harmonize it, bring it together, and to not just create a separate report, is to but cross-reference, as Priyanka mentioned, is to cross-reference a lot of this information. And it's not about reinventing the wheel. It is about using information wisely. It is about speaking the right. It is about talking about what the stakeholders want to hear, and it's about making sense of what you're talking about. So, like I mentioned, it is about the purpose of the organization. Now, in fact, under the under IIRC, there was another study conducted very recently. Is how is IR related to the Sustainable Development Goals, the SDGs? And I would encourage all of you to go and read that as well, because now that's the other movement we are seeing today. Is organizations are aligning themselves to the SDGs as well as the Paris Agreement. And your IR, I believe, is a very effective platform, a framework through which companies can talk about that. But how is my business impacting, or how am I contributing to achieving the SDGs? How is my organization contributing to achieving the Paris Agreement? And I believe the IR can be a very nice framework, perfect framework to bring that together. Yes. So just to end on mapping the capitals again, if I can just cite a few examples of, again, this question was asked, is how do I link my capitals to each other? So again, like mentioned, it is for the organizations to come together, but I can give you a very good example. If I can just use one example, is investing in digital services. Now, increasingly, like I mentioned, FIs are investing in digital services. And what is that doing? It is helping them penetrate richer. It is helping them bring operational efficiency. And for many, because now we have smartphones, tablets, we have the 4G mobile connectivity across India, it is helping them penetrate rural markets. So what is that doing? It is increasing your turnover from your rural activities, your rural products and services. So that's an example of where you're investing in digital is having an impact somewhere else. Similarly, like I gave you an example, investments in ethics and process training for employees has an impact somewhere else. So I'm sorry, I think I've run out of my time frame. So on that note, I'd just like to thank you all for giving me your ear, and I can take any questions also. Thank you so much. Thank you.
Thank you. Thank you, Abhijit, for making us go through this entire session of yours. I think you've touched upon the capitals in such great detail that I'm sure it will be very helpful for all our participants to understand how they can look at their capitals if they are from the financial industry and otherwise as well. Now, as I think we all know that the definition of the integrated reporting framework does say that it is the framework is primarily for the the users of IRR financial providers, and as we want to develop sustainable economies, we need long-term investors. We really need to widespread and across the board have transparency for all the investors, and have prudent regulations in the economies, to have disclosures which are beneficial for the organizations and for the investors as well. Now, I have a question for Michael. There's a question by Michael. Can you hear me?
I can.
Great. So I have a question from Trey Banerjee. So the question is, how has DBS arrived at value distribution for stakeholders in percentage terms? And is it a representation of only the tangible value created for stakeholders?
Okay. It's a good question, and there's actually not a lot of magic to it. All you really do is you take your profit before tax. The most conventional way of doing this is that you take your profit before tax, then you add back those elements, for example, bonuses or direct contributions to society, for example, through charitable givings or whatever it is. Then you arrive at a new income to be distributed number. And then what you do is you take the percentage that you have given out in dividends, that you've given out in bonuses, that you've given to charitable organizations, and so on. And that's as simple as it is, derived from that. Now, so what this is a very limited scope way of doing things. As I mentioned in my presentation, you could conceivably expand that widely by looking at many other ways you are contributing to these things. The challenge is to decide how much are you going to try and quantify and how much are you just going to explain as non-quantifiable contributions. I hope that helped.
Well, yes, I think that was pretty helpful. There's one more question for Abhijit, which says that in terms of Indian banks or any entity who is preparing to do integrated report, what do you think can be their global experience, slash exposure, slash recognition once they have adopted the framework?
Well, good question. See, the fundamental point is that India is a global economy now, and Indian banks in any form or way are now heavily integrated in the global economy. Whether it's about your trade finance, whether it's a project finance, so that is all there. And increasingly now, the Indian banking sector, the way, especially the private sector, it's opening up and the new banks have come up. They have a lot of influence from foreign investors. There's a lot of FII investments. Now, more disclosures, studies have also shown that more disclosures typically, firstly, lower your own risk. And also, it improves your standing among your FII, especially foreign investors. So now, especially in the North American, the developed markets, the investors are extremely aware and extremely proactive in asking for this information from Indian banks or Indian organizations in general they're investing in. So what an IR will do is it will definitely help improve your own disclosures, whether it's on ESG, whether it's in business activities. So I think from an investor perspective, it is. I think it's a very critical step. I hope that helps.
Yes. I have one last question, and since we are running out of time now, and it's quickly to any one of you who would like to address this. It's a fairly, I think, a simple one. What is the difference between output and outcome of the IR value creation process over time? Michael, Abhijit, any one of you?
Michael, you want to take it? I can.
If you go ahead, you take it. It's fine. I mean, I think both of us know the answer.
All right. So and to be brutally honest, currently the entire scope of reporting these days is about output. So when a company says that my turnover this, my net profit was this, and my number of customers, I have these many, or my balance sheet size is this, these are our outputs. Now, and what is an outcome is that I have done all these things. Like I have listed all these parameters, I have listed all these good numbers in my annual report. So what? For example, I'll give you 2 or 3 simple examples. Is if say for example, I had mentioned about my bottom of the pyramid bank. Now in my it says suppose an FI is very active in microfinance. Now, so that's your output is I have these many number of accounts. Your outcome would be, so what? The next step is what has been the impact of having so many accounts in your bottom of the pyramid. So that could be, for example, these many new businesses were started, right? So these many, simple example, my SHG members were able to buy this much livestock, and their family annual income was able to go up this much. Or it could be even women empowerment. I have these many women SHG members, and now they're financially independent. So that is the outcome, right? So the impact, again, so this is part of that, the whole social return on investment theory that is going. So that is your outcome. And then what will be the impact? Is that if I have these many women SHG members who have been able to increase their annual income up to this level, so what has been the impact? Is that now their children are able to go to school. The income of the entire region has gone up by this much. So that is the outcome. So it's basically just taking the numbers that you report on that I have, just take it a step further. So I think organizations can sit together, your internal stakeholders, and when you do sit down to discuss this, these will come out, and it can be reported. And I think FI should make that effort. I hope that helps.
Great. Yes, Abhijit, I think that's very well deciphered and articulated to understand the concept of outcomes and outputs. And so here I would like to wrap up and thank you everyone for being part of this session. And please reach out to us. This is my email ID. I'm based out of Mumbai. If you have any questions, you can drop me an email. I will direct these questions to Michael or Abhijit. And thank you all for giving us your time. Thank you so much.
Thank you.
Thank you.
Bye-bye. Thank you. Bye.